you can end up changing the entire system very easily, in particular because the system doesn't notice it's being changed for quite a while. Whereas the big end, putting it under pressure, the system recognizes that somebody's trying to change it immediately, and all of the antibodies come out and resist that change.
Hello again, and welcome to the fifth conversation between myself and Graham Boyd about money and impact. My name is Carsten Terp. I am the founder of the Danish impact media called Impact Insider, and Graham Boyd is the author of a book called The Ergodic Investor and Entrepeneur. He is convinced that we can create a lot more impact if we let go of the orthodox way of thinking about economics and invest our money wiser. Or at least he was last time we spoke. Is that still the case, Graham?
Absolutely still the case. I am absolutely convinced that we can make significantly bigger impacts in the world with the available resources we have if we invest it in a way that is significantly wiser and actually quite different to conventional wisdom on investing.
Good, because that's basically what this series of conversations is about. Because if we mean what we say about pushing the world in the right direction as investors and entrepreneurs, we need to understand economics in a new way. This time, we're going to talk about systemic impact investing, which is quite an interesting concept. It's basically about creating systemic change through the investments we make. And if we want to see systemic changes, we have to change the way we invest. That's what Jess Daggers, Alex Hannand, and Jason Jay claim in an article in Stanford Social Innovation Review. Investors who think about social change tend to be rooted in a linear reductionist form of logic, they write. One expression of this is what we call the single asset paradigm of impact investing, the idea that a single technology, project, or enterprise can bring about structural change in society. And they continue, the single asset perspective can be effective in appraising individual deals and exploiting specific opportunities for both impact and financial return, but it sits at odds with what is required to seed genuine transformation. Do you agree with this, Graham?
Absolutely, completely agree with it. That paper, it's only recently been published, but it's absolutely spot on. And the work that Transcap has been doing over the past years is superb. So no, fully agree with that. And there's a lot I can say on that, but back to you.
Yeah, so let me ask you, is it really a job for impact investors to create systemic change?
My sense that it is a big jump. And not just for impact investors, this is a big jump for pretty much all investors out there. And the reason, in some senses, goes back to perhaps two key pillars of that. One pillar lies in modern portfolio theory, which is built around the paradigm that you can treat each company as an independent entity, that you can achieve some kind of risk-reward profile just by investing in an appropriate blend of different companies without and treating each company still as discrete particles that do not interact with each other. And that simply doesn't work. It's becoming more and more clear that modern portfolio theory just cannot deliver what's on the tin. It cannot deliver the kind of balance of risk reward that it claims. The other side of it, of course, is if you look at all of us, we all have things that we know, all have arenas that we have been active in, that we're comfortable in. We all have our emotional attachments to things. And naturally, we're going to choose to invest in things that we know and love, are attached to, and where we understand it. Even Warren Buffett. Warren Buffett is perfectly clear. He is not going to invest in a business, no matter how good it looks on paper, if he doesn't actually understand the business model. So in a sense, it's perfectly rational for investors, whether impact, VC, private equity, whatever, to say, I'm going to invest in companies that I understand, in companies that I have some kind of an attachment to the arena that they're active in. For example, somebody who grew up in a country that didn't have ready access to clean water might well focus specifically on that clean water SDG and only invest their money after they became wealthy and became a philanthropist. They want to focus on clean water, and that's understandable. However, if the problems are systemic, created because all of the problems are interlocking with each other, exacerbating each other, the only way we can solve any of the problems is with a systemic solution.
But wouldn't it be fair to say that's not a job for me, that's for the governments?
Well, governments absolutely have a role to play here. Governments, though, especially more and more today, the primary job of government is to satisfy the electorate, not the whole population, and specifically to speak to that part of the electorate that might vote for them in the next election and keep them in power. And that means that governments are just as much subject to what I've just been mentioning as any other arena. Again, governments are not really able to look at the whole system. They may in some ways be better, but they're not well able, certainly not at the national level. Where what you've just said has a lot of relevance is at the level of cities, city governments. That's much more at the blend of being political and a conglomerate business. Managing the entire economy of a city has a lot in common with managing all of the business units of a conglomerate, and yet it still has the political element. So I think that city level, municipality level, or even bioregion, groups of villages, towns, cities, that's where there's a big opportunity to really craft system solutions to our interlocking problems. But for them to be able to do that, they can't do it without money. They're not going to be able to raise that money purely in taxes from the population. And again, that requires the impact investors to come in. And actually, it requires all investors to come in, not just those that self-label themselves impact investors.
So basically, just to sum it up, you're saying that we can't rely on governments to create this change in the systems. So if we want systems change, we need to take part in it ourselves.
Yes, exactly. In a sense, it's very simple. If the problem affects everyone, then it's everyone's accountability to solve the problem.
I read another article. You mentioned the TransCap initiative, and they have mapped out who should care about systemic investing. And basically, it's everybody. They mention foundations, large corporations, family businesses, development finance institutions, institutional investors, governments, and particularly relevant to our conversations, impact investors. And let me just read what they say about impact investors. Single technologies, startups, or social enterprises, no matter how ingenious their solutions and how brilliant their teams, are unlikely to change systems by themselves. So what matters is that these single point solutions are synergistically nested within a broader systems change effort. Do you agree with that?
Absolutely agree with that. I couldn't have put it better myself. As you've gathered, I'm a big fan of what TransCap is doing. This I'll take as a springboard into something that is an enabler for systemic change. So I think of systemic change as having two layers. So we have the one layer of how much in investing many interventions are being done today, which is just single asset solutions, focusing narrowly in on one or two stakeholders, focusing narrowly in on one capital, and that is just not systemic. The first layer of systemic is exactly as you've described there. You adopt a system lens that looks at objects and the relations between them. You're open to different understandings of success. You really understand the difference between, in the Cynefin diagram, between simple, complicated, complex, and chaotic. And you're working perfectly in the complexity, chaotic space. All of those things are in there. The other 2 points in there, finance is deprivileged. In other words, you're looking equitably at all of the capitals, not just financial capital, both in terms of governance as well as wealth share. And there's a focus on the real economy. That opens up space for the second layer of systemic investing. So to give you a story, up until Gustav Eiffel, the tallest tower that had been built was the spire of the church in Ulm, which was 162 meters high. And try as people did, and there were huge attempts being made to build a higher tower, but you really couldn't get much higher than 162 meters if you were building with stone, something that was relatively slender and hollow so that people could go up the middle. Clearly you can build a solid mountain that is 1 kilometer broad by 1 kilometer deep and is higher than 162 meters with a narrow tunnel up the middle. And Gustav Eiffel, by coming up with a completely new way of constructing iron instead of rock, he built immediately a tower that is 330 meters high, more than double the height of the tallest tower that had been built before. And this is something that's at the heart of what we've been doing in Evolute 6. We've spent 15 years developing developing building blocks so that we can shift from building economic systems out of rock, which you could call our current systems, into building them out of iron, so that we can build things that are far more capable of delivering the system impact we're talking about. And the things that are inside here, one of them is what we've been touching on in our conversations up until now. Focus on the real economy. The real economy has non-ergodic capital dynamics. Investors invest in a non-ergodic world. And the thing about the non-ergodic world is that the way we currently build businesses, they are designed to underperform in a non-ergodic world. We have to build fundamentally differently to perform in this non-ergodic world. And that way is to build in fractional profit pooling, capital pooling, collaboration between diverse independent companies. In other words, it means building systems of companies that share profit with each other. That sharing, by the way, is one of the things that is often missing in conversations about systemic investing. Ecosystems are both the system and the flows. All too often, I don't see the flows being adequately acknowledged. And a given system with different volumes of flow is a completely different ecosystem. So that's one of the things that is missing. So that needs to come in when you come into this highest level of systems change, where you're actually changing the building blocks in the first place. So where this drills down to is, to do systems change, you need to have high levels of both cooperation and competition between all of the different companies in the ecosystem in order to support high levels of flow and interaction between companies that are in some sense also in competition with each other, that may not like each other, may not trust each other, and may not agree with each other. And that's something that you and I have talked about as well, that question of how do you create collaboration between groups, companies, investors that maybe do not trust or like or agree with each other. By the way, as a side comment, there is a superb series of books by Adam Kahane, specifically on facilitating for agreement and collaboration between parties that don't like, agree, or trust each other. But the bits I'll close with in terms of how we build businesses and our approach to investing. The first one is, as I've said, this invest respecting the non-ergodic dynamics of capital, be an ergodic investor that invests in such a way to minimize the impact of the ergodicity error, the ergodicity fallacy that sucks capital out of businesses, that prevents impact. To do that, you need to incorporate in ways that maximize the systemic structural capacity for cooperation and collaboration. And the Fair Shares Commons class of companies is designed to include all stakeholders, all capitals, and to enable collaboration and competition between businesses and stakeholders that maybe don't like, trust, or agree with each other. And in addition, it's vital to use for the actual day-to-day operations things like sociocracy, fluid organizing design, and all of this requires a different logic. It requires a different way of thinking. Otherwise, you do what you could call systems washing, where you talk as if you're doing systemic change, systemic investing, but actually you're just doing business as usual. And again, that's where we need patterned dialogues between each other that can surface how we're thinking, how we're making meaning, where this comes from. All of that is described in my first book, Rebuild the Economy, Leadership and You, how we can build for systemic investing. And the last point I'll put in is the biggest shift in logic you can capture by saying when we're talking about it, we use the gerund form of the word rather than the noun. In other words, instead of talking about a pattern, we talk about patterning. And that's at the heart of systemic investing, is patterning rather than investing in a single thing or even a static pattern.
I know we've been around this before, but you mentioned ergodic and non-ergodic. And could you just, for those viewers who haven't seen our conversation about ergodicity, could you just very, very briefly explain what these concepts mean?
Yes. So almost everything in our lives, almost everything in our businesses is by itself non-ergodic. What that means is that if you look at the business over a period of time, the longer you make that time, it does not trend towards the mean. Whereas modern portfolio theory, economics, everything we're taught at university says, if you keep going for long enough in a world filled with volatility, you just need to keep going for long enough and you'll trend towards the mean. If the dynamics of capital were ergodic, then if you kept going for long enough, you would trend to the mean. In a non-ergodic world, you do not trend towards the mean. In almost all cases in business and in human life, the most likely outcome is that you trend to something significantly below the mean. And that's why we have situations where, whilst the business plan which is based on the average, the mean of all of the volatility extrapolated forwards 10 years, the business plan might show a company that will be perfectly successful over the 10 years, but then we know 11 out of 12 startups go bankrupt. And a big reason why they go bankrupt is because they do not trend towards the mean. And so the business plan is almost guaranteed to fail because it assumes trending towards the mean, but in our non-ergodic world, you do not. That's ergodicity versus non-ergodicity. And as I mentioned, the way nature has dealt with this in natural capital for 3.7 billion years is to recognize that competition and cooperation are two distinct dimensions, not polarities on a single axis. And nature sits at a point over here of very high cooperation and very high competition. And the cooperation is tangible. It's pooling natural capital, or in a business case, pooling financial capital between competing companies.
Thank you for clarifying that, Graham. Now let's get back to systems change. So if I were an investor, let's say I were Warren Buffett, and I would like to change systems, what should I do? How should I start?
So there are two places you can start to change a system. You can either start with the entire system, or you can start with the individual building blocks. The issue is, if you start with the entire system, the tools that people tend to go for are the tools of big government, policies, incentives, regulation, that kind of thing. And yes, that can drive systems change, but it requires a lot of force. It requires a lot of effort. It's trying to push the existing system in a way that is contrary to the very essence of how it's built. And the building blocks are an expression of that essence. Winston Churchill said something, one of his well-known quotes is something along the lines of, "We shape our buildings, and then our buildings shape us." And so we've shaped the buildings of our current institution of business. And now that is shaping us. And that's the other way of changing it, is to change the elementary building blocks that we build our businesses with. And that's our chosen strategy in Evolute 6, to work with the Fair Shares Commons form of companies, which includes all stakeholders, all capitals. And by changing at the elementary level, who has governance power, how that governance power is implemented, changes how companies can interact with each other, how capital flows between companies, all capitals, not just financial. And that, by changing the essence of the building blocks, like going from stone to iron when Gustav Eiffel built his tower, you can end up changing the entire system very easily, in particular because the system doesn't notice it's being changed for quite a while. Whereas the big end, putting it under pressure, the system recognizes that somebody's trying to change it immediately, and all of the antibodies come out and resist that change. Doing it in this, almost doing it like a virus or like a Trojan horse, changing the fundamental building blocks, and then they just will sooner or later reach a tipping point where they spread out across the entire system, and the entire system just collapses into the new system. This is Buckminster Fuller's recipe. Don't try to change the system. Build a new system that inherently works better, and the old system will just move over when the time is right.
Sneaky you sending in a Trojan horse. But Graham, let me ask you, if you focus on the single building block, isn't there a risk that you'll end up doing just traditional impact investing focusing on one objective or one company. How do you go from that into changing the system?
Perfect question, perfect question. So that's the next layer up. And this is what we're doing. We start with building blocks that are inherently designed to create collaborative, competitive ecosystems of companies. And then we build and invest in a minimum viable ecosystem. So, for example, one of the projects we're working on in Costa Rica is a land-based project. The land is already there, and a number of different companies are being created in some sense related to that land. And these companies are diverse and interlocking. So we're not trying to change the whole system, but we're starting with different building blocks. But then what we invest in is already from day one a minimum viable ecosystem. And I think that's the route. You change the building blocks, you work at the minimum viable ecosystem level, something that is a bit like if we want to create an elephant, we do not start with a single amoeba and try to scale it to the size of an elephant. Instead, what we start with is an embryo. The cells keep splitting up until eventually you have a huge number of cells, enough to make an elephant, that are specialized in different organs. And that's really what we're doing at the moment is, let's say, building elephant embryos that are sufficiently grown to actually be elephant babies then by the time they come out of our incubator, and are sufficiently viable that they can continue to thrive and grow to a full-sized elephant on their own. And then they form a herd of elephants. Or maybe, given last week's talk, I should have used the zebra as an example rather than an elephant, and they form herds of zebras.
I am so glad that you mentioned elephants, because I was missing all the animals that we have in our conversations, but here they were. Listen, Graham, the article from Stanford Social Innovation Review also contains an example that I'd like to give to you. In 2009, Betsy and Jesse Fink initiated a program of investment to tackle the challenge of food waste in the United States, and they combined philanthropic grants, direct investments in startups, and formation of a backbone organization. And according to a recent study from MIT, millions of dollars from the Finks catalyzed billions of annual investment into a web of complementary solutions. What do you think of that?
I think it's absolutely superb. When I read about that in this article, I was thrilled to see it. I'd not known about that specific example before. And I want to highlight something, the backbone organization. I think that is critical to get, and they did an ecosystemic intervention there. They worked at the level of the entire ecosystem with multiple different companies. If that is just left to loosely organize on a purely voluntary basis between the individual companies on a purely peer-to-peer way, that loses some of the power of having a backbone organization that really has accountability for the ecosystem as a whole. There are, if we think of nature, the soil, in some sense, the soil of the valley is part of the backbone container that the whole ecosystem is in. And maybe I'm stretching things here a bit. If you're a biologist, please don't shoot me. But possibly the entire fungal network that spans an entire forest or spans an entire ecosystem, maybe in nature that could be considered as the backbone organization that does things that the roots of the trees, the plants, the animals, and a peer-to-peer interaction can't do. And so I do think that having this backbone organization is essential. It also comes back to, if you look at some of the most successful companies historically, they've made use of conglomeration. Conglomerating has been central to their success. If we look at the Hanseatic League, if we look at things like the Japanese Keiretsu, even if you look at modern companies like Procter & Gamble, they're able to do things because you have this backbone organization that takes care of the entire ecosystem, and you have a lot of freedom for the individual brands or companies internally. So that's what I wanted to highlight and emphasize as a key thing coming out of there, is the necessity to have this backbone organization, to not just think you can, it's, as John Fullerton put it when I was speaking to him a couple of years ago, and he said, okay, Graham, I think I get what you're saying. What you're saying is 1,000 trees in individual pots is nothing like a forest of 1,000 trees. And that's the big difference. It's not a systemic investment. If you have 1,000 different isolated companies and you just spread your money across all of them, but there's no backbone organization facilitating to optimize the ecosystem's impact, the flows and interactions between those companies or trees.
Graham, that was almost magical, because by mentioning the 1,000 trees, the forest, you brought us back to our very first episode. And actually, this is the end of season 1. And now we've formed a ring. So I really like that. But Graham, I was wondering, provided, of course, that some biologist doesn't shoot you, what do you think of the idea of a second season of these conversations?
I love the sound of a second season, a little bit of a break for us to push our respective work forwards and to digest. And in particular, what I would love is for everybody who's enjoyed these conversations and articles to send in their questions, suggestions for topics we should cover, and then we can have a second season that takes a next step beyond this season.
That sounds great. That's exactly what I was hoping you would say. So thank you everybody for watching. If you have questions for Graham, you can send them to me on carsten@impactinsider.dk, and we'll see you when we come back with more talk about money and impact.